Hi everyone and welcome to the Panic Drop channel. In this video, we will discuss 4 important factors that drive stock prices to go up in the long run. Because many great stocks such as Apple, Google, Mastercard and many more have been going up for years. Therefore, this video is made to help you understand the key indicators that make these stocks go up in the long run. Stay tuned until the end of the video as I will be sharing my personal investment strategy and where I place the most focus. So this is data from Bloomberg showing all 4 indicators that have an influence on stocks. First on the list is share buybacks. This green area, accounting for 38% of stock price movements. And share buybacks occur when a company purchases its own shares from the market, thereby reducing the number of shares outstanding. This action returns capital to the shareholder and increases the value of each share, driving up the stock price in the long run. Share buybacks can be compared to a pizza analogy where a whole pizza represents the company's total value and each slice represents a share of the company's stock. When a company decides to buy back shares, it's essentially reducing the number of pizza slices available, which makes each slice more valuable, just like how each share becomes more valuable, potentially driving up the stock price. So, for example, in the last 10 years, Apple has been a significant net buyer of its own stock. During this time, the company bought back a total of 550 billion worth of shares, which equates to approximately 11 billion shares. In contrast, Apple issued only 1.5 billion shares to employees during the same period, resulting in a decrease of approximately 38% in the total number of outstanding shares. So this should be 38%. The second factor, the red area, is dividends, which accounts for 7.5% of stock price movements. So basically, the company gives its shareholders treats, and this makes people feel confident about the company. So they want to own more of the company's shares. And when more people want to buy the company's shares, the price of the shares go up. For example, Johnson & Johnson has been increasing its dividends over 50 years now. This means that every year J&J has given out even more dividends than the year before, which is really great news for the people who own a part of the company. And that's one of the reasons the share price of J&J has been going up in the long run. The third factor, accounting for 40.5% of the stock price movement, is earnings per share. And this is the most important factor that can cause a share price to go up in the long run. Because when a company reports strong earnings, it means that it's making more money and becoming more profitable. And this is really good news for the company and its shareholders because it shows that the company is doing well and increasing in value. When people see that a company is doing well, they may want to buy more of its stock, which can cause the stock price to go up again. You can check this easily on one of my favorite financial websites, Seeking Alpha. For example, let's take a look at Mastercard's financials. If you go to the financial section, you can check net income, revenue, and cash flow from operations. So for example, revenue, you can highlight the years of revenue and you can see that it has been increasing consistently over time. There was this small dip in the 2020 period when we had the pandemic, but that's normal since a lot of people stopped shopping during the lockdowns and spent it less. You can do the same for net income. You can see it's pretty consistent going up each year. And then you have also the cash flow from operations right here, which is going up year after year. So that's an easy way to check quickly if a company is earning more year after year. By the way, Seeking Alpha is currently offering a nice promotion. You can get 58% off your first year Seeking Alpha premium subscription, which is only $99 for the whole year. I'll post the link to sign up with a discount in the video description below. Last but not least, you have the final factor driving stock prices, which is the PE multiple expansion, accounting for 14% of the stock price movements. And when PE multiple expands, investors are willing to pay more for a stock. And this can happen because of something called the Federal Reserve policy. The Federal Reserve is a group of people who control how much money is in the economy and how much it costs to borrow money. When they lower interest rates, it can make it easier and cheaper for people to invest in the stock market, driving up stock prices. For example, in 2020 and 2021, interest rates were low and assets like stocks were going up. Even the companies that did not make any profits were up like crazy. In 2022, the Fed started raising interest rates, making it harder and more expensive to borrow money, which caused stock prices to go down. At that point, it's not a good idea to invest in any company that's not profitable. Alright, these are the four main factors that can affect stock prices in the long run. Now let me share my personal investment strategy. I mainly focus on high quality stocks that consistently increase their earnings over time as it has the biggest impact on the stock price and provides long-term stability and growth. If the company also buys back shares or pays out dividends, that's an added bonus. But to ensure the survival of your stocks in the current market, it's crucial to invest in companies with consistent earnings growth. That's it for today. Thanks for watching. I hope you found this content helpful. If you did, please don't forget to like and subscribe to stay tuned for more videos like this. Take care and have a great day. Bye bye.